The next session on the program is the use of ACTUS in long-term forward-looking analytics, the case of pension funds. And the presenters are currently located in Europe and will be coming over the Zoom feed. And so, Dylan, are we ready to launch them? Okay, thank you very much.
So, hello everybody, this is Walter and Veronica from Switzerland. I hope you can hear us.
Yes.
Very good, very good. So thank you very much for the opportunity to talk to you. And yeah, so as Alan said, we want to talk to you today about how we use ACTUS and also analytics to help pension fund managers to make the right or the better or sound business decisions. And yeah, we will first use a presentation. So we will launch a presentation. I see you should see that. And later we will also use our system and show a live case. Now, as I said, so our aim, or what we did, or our aim is to make sure that pension fund managers make sound decisions. And what we have built for them is a business simulation tool so that they can see what is the impact in the future of the decisions they are making today. Now, I will start to explain to you again, or let's say to remind you again, what a pension fund actually, how it operates and what the challenges are. And then we can go a bit more in how we model that. And later, actually, how we set it up in analytics, in ACTUS, and later how we model it in analytics. Good. So what is a pension fund? Now, we talk here about Swiss mandatory pension funds. That means these are mainly non-profit organizations that help employees to save for their retirement. So the timeline goes like that. An employee joins the fund, typically with already bringing some retirement savings with her. Then she works hopefully up to her retirement for the same employee. That means she's a member of the pension fund, makes annual contributions, part of their salary. And then at a certain point, these retirement savings get converted into a pension, a fixed inflation adjusted pension in Switzerland. And then hopefully she can use this for many, many years, and sadly at one point she will die. Now, how does this look from the viewpoint of the pension fund? Now, from the viewpoint of the pension fund, what is important that these payments, the employee is, or these savings and the money of the employee, so these retirement savings, this is still the money of the employee. So the employee kind of grants a loan to the pension fund, and the pension fund will also have to pay interest on that loan. Usually this is variable interest that depends on how good the investment income of the fund was. Then at the time when the employee retires, this money gets converted in an annuity, and at that point the pension fund becomes the owner of this capital, but then they have an irrevocable commitment, of course, to make these pension payments. Once the pension payments are, let's say, announced, they are inflation adjusted but fixed. Of course, when calculating the pension, the fund will also assume a certain investment income, let's say interest they make on that capital they have from the employee. So what is important here to notice that interest, actually investment income, is extremely, extremely important in that process. We call the investment income, actually the market as a whole, we call it the third contributor. We have the employee who is a contributor, we have the employer who is a contributor, and then we have also the market that is a contributor. So if the investment income is small, then also that means the employee will not have saved as much, will not have as much retirement saving. And also here to pay the pensions, there is an implicit interest assumptions in the payments. So that's in general how a pension fund works in Switzerland, not much different how it works in the US. When we look at it in the usual way in the balance sheet, and that's now quite important because we will show you this picture several times later. This is the balance sheet of the fund. You see the left side, the assets, the right side, the liabilities. If you go to the right side first, there are two main liabilities. First, the retirement savings of the employees. And then second, the present value of all the future actually declared pensions. On the left side, we have the assets. And of course, that is now what the pension fund is doing, investing in those assets in the market, usually in a diversified portfolio. You see this fund here is in a fortune situation. Actually, typically, that's the situation the pension funds are in. The assets are more than the liabilities. We have here a surplus, and that surplus is also very important. That gives the fund the ability to take risk. And taking risk is important because without market risk, you don't make a lot of investment returns. Good, so keep that picture in your head. On the left side, green, the investment portfolio. On the right side, these two main liabilities, A, to the employees, and B, the present value of the pensions they have granted. And then that surplus, which is the nice part, that surplus usually belongs to all the members. Now, what is the challenge of the pension fund? The challenge of the pension fund is to keep this system in balance. And when I say in balance, this is a balance between short-term stability and long-term attractiveness. What do I mean by that? We have seen our fund has a surplus. And of course, this means sound financials. And of course, they want to keep sound financials. But keeping sound financials would actually mean that they avoid losses, and avoiding losses means you take a low amount of risk. On the other hand, what they have to do, they have to be attractive in the future, pay good pensions, being able to help employees save enough for retirement. And that means they absolutely need investment income. If they want the investment income, they need to take some risk. If they take some risk, then of course they jeopardize a little bit the left side. And that's what the management has to keep in balance. Completely different for every fund. It depends a lot on the structure, how many retirees you have per employee, or how many employees you have per retiree, etc. Now, that's about the setup. What we do, we now model the total business of the pension fund and then project it into the future. But Veronica will tell you more about that.
Thank you, Walter. So now to the real case. If we want to support pension fund managers, we need to create a trustworthy replica of the current pension fund situation, and as Walter said, project this situation into the future, so that the pension fund can see what influence current decisions might have onto the future development. So let's keep in mind, we are just speaking about how can we display the current situation. And this is where ACTUS has been very handy. As Walter already stated, the liability side is quite unique. The asset side resembles the one of the bank. But when we use the ACTUS contracts, we can actually unify all these positions into one language. And this is extremely important for further decisions. So let's briefly go over the asset side. This is relatively straightforward. We model, for example, the bond portfolio with principal at maturity, the stock portfolio with the stock contract. As said, also at the liability side, we can actually replicate these quite rich cash flows. And here we, for example, use the exotic linear amortizer to mimic the future cash outflows on the current pensioners. Now we will go deeper into two contracts, the PAM and the LEX. So if we want to replicate the bond portfolio, we of course use several PAM contracts with which we mimic the correct duration and the fund, the interest sensitivity of all the bonds that the pension fund is invested in. That's why you can see short-term, mid-term or long-term bonds and the regular coupon payments. Let's now go to the side that is unique to a pension fund, and I will show you how we represent, for example, the current pension obligations. So we make a use of the exotic linear amortizer contract that helps us to exactly build up and display all the future cash flows. It's important to say this information is already there. This is an information that the pension fund's actuary has at disposal. We just take this contract and can implement these cash flows. So these are the cash payments to existing pensioners over the next 45 years, and we can see they reduce over time as the people are slowly passing away. Now, let's keep in mind, until now, we have highlighted or we have spoken about the current situation of the pension fund. Of course, now let's take this opportunity and go into the future. If we want to make projections, we also need to consider that the currently working people will later become pensioners. That's why we make a use of a different type of contract to mimic the people who will become pensioners later on, and we use the annuity. Here with this contract, we can at any point in time settle the level of the retirement payments, and we can also define how long will the person spend during the retirement age. And now Walter will use this background where we set up the current balance sheet and talk more about the approach, how we simulate the pension fund business.
Yes, I will only be very brief, then I give it back to Veronica. So remember that Veronica has shown us how we set up the pension fund. So we have now explained the current business. But of course, what we want to do, we want to project that current business into the future. So this is the business currently, and we want to project it in the future. And so we need to at least have three things under control. First, there is an ongoing operation. And the ongoing operation, you can imagine, that is employees are leaving and joining the fund, employees retire. That's what Veronica explained before. Then these become new annuities that are added to the pensions, and then pensioners are dying. That's the liability side. On the asset side, of course, periodically, every 3 or 6 months, we rebalance back to the strategic asset allocation. So this is the ongoing business. Then things are happening where the pension fund managers do not have influence over. For example, market crashes. That is something, of course, we need to simulate. Then longevity, that's a problem these days that we have in all countries. Then it could be that the structure of the fund is changing, that we have fewer employees per pensioner, and could actually also be that there's something regulatory that, for example, the retirement age could change. So these are the things the pension fund cannot influence. But of course, what is really important or interesting for the pension funds is the stuff where they have control over. So the red stuff are decisions. And the typical decisions are on the asset side Do I want to change the asset allocation, or do I want to invest in new asset classes? As you might have heard, for example, things like the stock market has completely changed in the last 30 years. These days, we have less public equity, we have more private equity, and pension funds thinking about investing in those things. These are typical simulations we have to do for them. And then, of course, maybe we have to adjust pensions, and that we will show you a case on that front. And then also pension funds could merge. So these are the typical decisions. That's what we have to show in our system. Now, I think, Veronica, we go to our, oh yeah, I forgot one thing. I will show you the system in a sec, but we work with two systems. What we will show you is our cockpit. Our cockpit is what the pension manager sees. That's where all the data, historical, but also simulation, comes together, hopefully in one picture. But behind the scene, we have analytics. Analytics is based on ACTUS to do all the simulations, right? Very, very heavy, very, very powerful machine, but not so easy to operate and not so easy to read. And that's why we bring it back into our cockpit. So Veronica, please show them our cockpit. This will be a bit, as usual, a bit complicated when we show something on the screen. It might be that it looks a bit small on your side. We will try to zoom in as much as possible.
I hope you can see the text. Please, can you confirm whether it's too small or large?
Good.
Sorry?
Good.
Oh,
Very good.
thank you. Okay, so this is our digital platform that we have built up for our clients. As Walter said, we offer all information about the pension fund under this one roof. We offer here historical and also projected data. Let me briefly lead you through this left-hand side. Here we have different stories in the My Pension Fund story. We have consolidated view on the pension fund and information about the whole balance sheet, all cash flows, and also profit and loss statement. But we can also go into more detail and look, for example, on the age, structure of the insured people, or get some more information about the investments. But today we will dedicate ourselves to this part. This is actually the picture you have already seen in our slides, but this is the real pension fund's balance sheet. As promised, not only is here all the information about the past, but we can go also with this time slider into the future. We are extremely proud about this feature because we actually display the projected data within the exactly same data logic as the past. And this is quite nice visualization, but of course we can, every time in every story, we can go into more detail and see the exactly quantified numbers. But let's now go back to the balance sheet and talk more about the projection. So this is the current balance sheet. We write here projected because the pension fund business is quite a slow industry, so the data wasn't confirmed yet, but let's assume that's true. And here we can see the current balance sheet. Just keep in mind that the balance sheet size is now about 6.3 billion and the asset surplus is 850 million. Now, if we want to go into the future, we of course need to make assumptions about the future. And these assumptions we divide into three main categories. At first, business strategy. Second, market scenario. And third, the accounting rule, the evaluation. So what does it mean, business strategy? The pension fund can of course decide what they want to do in the future. So what strategic asset allocation they want to follow, what is the level of the interest on the savings. Market scenario is something that they cannot actually manipulate. So here we simply summarize our assumptions about the returns of these individual asset classes. And because these assumptions create certain cash flows in the future, because we are simulating the whole pension fund business, we can evaluate these cash flows under different accounting standards. For Switzerland, for us, applies the local GAAP standard. If we were abroad, we could use IFRS. Let's now see what happens if we project this balance sheet into the future under the current strategy and the expected market scenario. I hope you can all see that if we go further, the pension fund is actually growing in its size. Previously, it was 6.3 billion, now it's 7.5 billion, and the asset surplus has risen as well. Why is that? Because we actually assume that the markets would evolve as expected. So the returns are quite nice. But of course, this is not the only thing we need to consider in reality. We need, for example, to take a look on possible risk. So let's now project this balance sheet under the current strategy, but assume that tomorrow the global financial crisis would happen. And now, sorry if you cannot see it, let me do this again, but you can see there is completely different situation. So now, if we were in 2027, the asset surplus is gone. All the reserves were used to cover the payments to the retirees. Also, the balance sheet size has shrunken, and the pension fund is experiencing underfunding. So why is this actually important? It looks very simple, but simulating such complicated business is actually an advanced simulation. And you can see that ACTUS helps us immensely to build up the whole pension fund and to get view on this pension fund as one entity. And also we can implement different strategies and scenarios and project this balance sheet into the future under different combinations that are relevant. In this way, we support the pension fund management, and it's important to highlight that even though these are advanced simulations, the results we got with the help of ACTUS and analytics within a few minutes. And now Walter will lead you through one real business case where we addressed the topic of longevity.
Good. So I will zoom in a little bit. I go to the table. This is the balance sheet. So the assets we leave, the opened liabilities, benefit obligations we open. And what I'm interested in here is benefit obligation pensioners. And especially what I want to do here is I go to the year 2032. So you see how the fund looks like in 2022 and then 10 years later. Now this fund is the same pension fund that we have shown before, the one with a balance sheet size of about 7 billion Swiss. That's about a bit more in dollars, right? So this pension fund wondered what will be the impact if they lower the pensions to the new pensioners. Why that? Well, in Switzerland, interest rates have been low for many, many years. They are still low. They are actually lower than the implicit interest rate promise in the pensions, in actually the time when I convert retirement capital in pensions. So together with longevity, this is a time bomb. Actually, Swiss pension funds typically pay too high new pensions to new pensioners. But of course, this gets very political. If you lower the pensions, you don't make friends. So therefore, pension funds usually hesitate. So this pension fund now wondered, what will be the impact if I lower the conversion rate. With conversion rate, we mean the following. Conversion rate is the rate at which I convert the retirement savings into a pension. So if the conversion rate is, say, 5.7%, that means if the employee has saved 1 million in capital, this will be converted at 5.7%. That is 57,000 into an annual pension of 57,000. And this pension fund wondered, what is our benefit if we now lower that to, say, 5.1%? That means 6,000 less pensions, a pension of 6,000 less for the same capital of 1 million. This is about 500 Swiss per month. Now, remember, we cannot change the pensions for existing pensioners. We can only change for new pensioners. And this is actually not so easy to calculate because it's not something that is happening right now. It's something that happens in the future. So we have to check how the benefit obligation to pensioners, so the present value of the future pensions, how that changes over time. Now, you see, in the next 10 years with the current strategy, that means a conversion rate of about 5.7%, this goes up by about from 2.7 billion Swiss to 2.8 billion Swiss in 2032. Now, for us in ACTUS, this is so easy to change. Veronica has started that. I just go to lower pensions. And why is this for us so easy to calculate? Because in the ongoing business that we always simulate, we all the time get new pensioners and we all the time have to convert existing capital into pensions. Just we change one number, namely to a conversion ratio, and we see here the impact. The impact is you might not have, this is now in 2032, this is now lower by about 120 million in 2032. Remember, there is no impact today because we don't change today's pensions. We change the pension obligations in the future with the new retirees. And as I said, very, very easy to do for us with just a mouse click. You also see, actually, if you had seen the numbers, I will not flick back and forth, that while the pension obligations to pensioners have lowered by lower conversion rate from about 2.82 billion to 2.7 million, the asset side hasn't changed much. Why didn't the asset side change? Because what we are looking at, this number 2.7 billion, is a commitment to make future pension payments. So this is the present value of things that are happening later than 2032. The thing that changed, though, is the asset surplus. So I kind of took money away from, say, the employees and put that to pensioners. The great thing about ACTUS and the great thing about analytics is that I can dig in if I don't understand the number. So, for example, I want to see what is the impact on the pensions actually. How much more or less pensions do I pay if I lower? Do I pay in 2032 if I lower the conversion rate? I go cash flows table. I have the whole business here. I can look at anything. I look at regulatory benefits, retirement pensions, and actually you would see if I go to 32 again, retirement pensions. This is about, I'm here on the lower pensions. This is about 225 million. These are the pensions paid out if I have lower pensions in 2032. And if I go to the regular strategy, this is 231. So the difference is only about 6 million more pensions in that year. But again, they will have to be paid until all these new pensioners die out. So in the end, it's a 100 million impact. The story was then like that. The pension fund thought, okay, 100 million is an impact in 2032, but this is politically too negative. So they said, okay, let's wait again a bit until we lower that. So more or less, that's it. I think we have already used our time. Just as a summary, I mean, what is really, really great for us is that we have a full transparency, that we actually model the whole business and not an aspect of the business. We can very easily change parameters and then compare two scenarios. We have a great consistency over time, and especially everything cash flow based is fantastic for pension funds, because the pension fund business is a cash flow business. Also, the fact that we can use different accounting statements is very good, especially for big businesses that operate in Switzerland, but say report somewhere in the EU. They have to report that under local GAAP and also IFRS. But I think we leave it by that. Can you go again? Share. Yes. So here we are again. Thank you much for your attention. I know we are already a little bit behind schedule, or you were before we came a little bit behind schedule. If there are any questions, we are happy to address them. If you have to move on, we understand that. So back to you, Washington.
I have to say, my hope that we'd be able to stay on schedule is eroding slowly. The next speaker, yeah.
May I ask you a question? Okay.
Out of your time. No, go ahead, ask the question.
Okay. So you showed the balance sheet of this pension fund, the prediction for 2032, and you showed the impact of lowering the pensions, but you had such an increase of the assets that there is no rationale for lowering pensions.
Yeah, you're absolutely. We have, what I showed you is under the current assumption, right? And the current assumption was that the pension fund makes a return of 4% per year. This is actually quite the good case. Of course, we should then really check under scenarios what how much does this impact then the whole situation. But I absolutely agree with you. And that's also why that pension fund in this situation did shy away from changing the pensions. In the end, it was 100 million on a balance sheet that is about 6 billion. So they said, okay, for that, we don't take the political risk. But I mean, if interest rates stay as they are, at a certain point, we will have to do that.
Thank you very much. By the way, and it's very nice application.
Thank you.